First day at the new job, stack of paperwork. Somewhere in the middle is a form asking you to choose your retirement plan. Words you have heard before, but could not actually define under pressure. Traditional or Roth, percentage of your paycheck, a drop-down menu of acronyms. You pick something reasonable sounding. You move on. Nobody explains that this single form is going to compound into one of the biggest financial decisions of your entire life. Here is every type of retirement fund, who it is actually for, and what happens to your money depending on which one you choose. 401k. This is the retirement account most working Americans actually have, whether they fully understand it or not. A 401k is an employer-sponsored retirement plan. You contribute a percentage of your paycheck, pre-tax, meaning that money never gets counted as taxable income in the year you earn it. Many employers offer matching contributions, adding money on top of what you contribute, up to a certain percentage. That match is free money. Not contributing enough to capture the full employer match is one of the most common and most expensive mistakes people make with their retirement savings. Your contributions and any growth sit tax-deferred until you withdraw them in retirement, at which point withdrawals get taxed as ordinary income. The account has contribution limits set annually by the government, and early withdrawals before age 59 and a half typically trigger both taxes and a penalty. Roth 401k. This is the same employer structure, with the tax treatment completely reversed. A Roth 401k is also employer-sponsored, often offered alongside the traditional version. Contributions happen after tax. You do not get an immediate tax deduction the year you contribute. What you get instead is tax-free growth and tax-free withdrawals in retirement, provided certain conditions are met. The core decision between traditional and Roth comes down to a single question. Do you expect to be in a higher tax bracket now, or a higher tax bracket in retirement? If you expect your tax rate to be higher later, paying tax now at a lower rate through a Roth can save significant money over decades. If you expect your tax rate to be lower later, the traditional option often makes more sense. Many people split contributions between both, hedging against uncertainty about future tax rates. Traditional IRA. This is the retirement account you open yourself, completely separate from any employer. A traditional IRA, individual retirement account, lets you contribute pre-tax dollars, similar to a traditional 401k, but through a personal account you set up with a brokerage rather than through your employer. Anyone with earned income can open one, regardless of whether they also have an employer-sponsored plan. The contribution limits are significantly lower than a 401k, and the tax deduction for contributions may be limited or eliminated if you or your spouse also have access to an employer plan and your income exceeds certain thresholds. Traditional IRAs are useful for people without access to an employer plan, or as an additional tax-advantaged account alongside workplace retirement savings. The same tax-deferred growth and ordinary income taxation on withdrawal applies here as well. Roth IRA. This is the individual account built on after-tax contributions, with one significant catch. A Roth IRA functions similarly to a Roth 401k. After-tax contributions, tax-free growth, tax-free qualified withdrawals, but it comes with income limits. Once your income exceeds certain thresholds, you become partially or fully ineligible to contribute directly. For those who qualify, a Roth IRA offers significant advantages, particularly for younger workers early in their careers, likely in a lower tax bracket now than they will be decades later. Roth IRAs also offer more flexibility than most retirement accounts. Contributions, though not earnings, can generally be withdrawn without penalty at any time, since you already paid tax on them. This flexibility makes the Roth IRA one of the most versatile retirement accounts available for those who qualify to use it. SEP-IRA. This is the retirement account built specifically for people who work for themselves. A SEP-IRA, Simplified Employee Pension, is designed for self-employed individuals and small business owners. The contribution limits are dramatically higher than a traditional or Roth IRA, allowing business owners to save significantly more for retirement in years when the business performs well. Contributions are tax-deductible, made pre-tax, similar to a traditional IRA, but at a much larger scale. If a business owner has employees, they generally must contribute the same percentage to eligible employees' SEP-IRA accounts as they contribute to their own, which is an important consideration for anyone running a business with staff. SEP-IRA, as are relatively simple to set up and maintain compared to more complex retirement plan structures, making them a popular choice for solo business owners and freelancers. Simple IRA. This is the retirement account built for small businesses that want something easier than a full 401k. A simple IRA, savings incentive match plan, is designed specifically for small businesses, generally those with 100 or fewer employees. Employers are required to either match employee contributions up to a certain percentage or make a fixed contribution regardless of whether the employee contributes at all. Employee contribution limits are lower than a 401k, but the plan is significantly simpler and less expensive for a small business to administer, without the more complex compliance requirements that larger retirement plans require. For employees at small businesses, a simple IRA functions similarly to a 401k in terms of pre-tax contributions and tax-deferred growth, just with lower contribution ceilings and a more restrictive early withdrawal penalty period during the first 2 years of participation. 403b. This is the retirement account for people working in public service and non-profit organisations. A 403b plan functions very similarly to a 401k, pre-tax contributions, potential employer matching, tax-deferred growth, but it is specifically offered by public schools, certain non-profit organisations, and select tax-exempt institutions, rather than private for-profit employers. Teachers, professors, hospital employees, and non-profit workers frequently have access to a 403b as their primary employer-sponsored retirement option. The investment options within a 403b have historically been more limited than a typical 401k, though this has improved significantly in recent years as regulations have evolved. Contribution limits generally mirror 401k limits, and the same tax treatment and early withdrawal penalty structure applies. 457b. This is the retirement account specifically for government employees, with one unusual advantage. A 457b plan is offered to state and local government employees, and in some cases, certain non-profit executives. It functions similarly to a 401k in terms of contribution structure and tax treatment. The significant difference is around early withdrawals. Unlike most retirement accounts, a 457b does not impose the standard early withdrawal penalty if you leave your job, regardless of your age, though the withdrawal is still taxed as ordinary income. This makes the 457b uniquely flexible for government employees who may retire or change careers earlier than the standard retirement account age thresholds typically allow without penalty. Some employees have access to both a 401k or 403b and a 457b simultaneously, allowing for significantly higher total tax advantage retirement contributions each year. Solo 401k. This is the retirement account built for business owners with no employees but themselves. A solo 401k is designed specifically for self-employed individuals who have no employees other than possibly a spouse. Because the business owner functions as both the employer and the employee within the plan, they can contribute in both capacities. As an employee, up to the standard employee contribution limit, and as the employer, contributing an additional percentage of business income. This dual contribution structure allows for significantly higher total contribution limits than a SEP-IRA in many situations, making a solo 401k often the most powerful retirement savings tool available to a solo entrepreneur. Both traditional and Roth versions are typically available, offering the same flexibility in tax treatment that standard 401k plans provide. Pension plan. This is the retirement account that works completely differently from everything else on this list. A pension, formerly called a defined benefit plan, guarantees a specific payout in retirement, typically calculated based on your salary and years of service, rather than depending on how much you personally contributed or how your investments performed. The employer bears the investment risk, responsible for ensuring sufficient funds exist to pay promised benefits, regardless of market performance. This is fundamentally different from every other account on this list, which are defined contribution plans, where your eventual retirement income depends directly on contributions and investment returns, with you bearing the investment risk. Pensions have become significantly less common in the private sector, though they remain prevalent in government employment and certain unionized industries, offering a guaranteed, predictable retirement income stream that most other retirement accounts simply cannot match. Thrift Savings Plan. This is the retirement account built specifically for federal government and military personnel. The Thrift Savings Plan, the TSP, functions as the federal equivalent of a 401k, available to federal employees and members of the uniformed services. It offers both traditional and Roth contribution options, generally low administrative fees, and a limited but well-regarded selection of investment funds. Many federal employees also receive automatic and matching contributions from their agency, depending on their specific retirement system. The TSP is widely considered one of the most cost-efficient retirement plans available due to its exceptionally low expense ratios compared to many private sector 401k plans, which often carry significantly higher administrative and fund management costs that quietly reduce long-term returns. Annuity. This is not a tax-advantaged retirement account in the traditional sense. It is an insurance product frequently used alongside retirement savings. An annuity is a contract with an insurance company where you contribute a lump sum or series of payments in exchange for guaranteed income payments, either immediately or beginning at a future date. Annuities are often used by retirees seeking guaranteed income that cannot be outlived, regardless of how long they live or how the market performs. The trade-off is that annuities often come with significant fees, limited liquidity, and complexity that makes them difficult for many consumers to fully evaluate before purchasing. Unlike the accounts covered earlier, an annuity is a product you buy, not an account structure with specific government-defined tax rules, and the details vary significantly depending on which insurance company and specific annuity product you choose. Every type of retirement fund. 12 completely different structures, each with different rules, different tax treatment, and different ideal circumstances. The form you filled out on your first day was never just paperwork. It was the first decision in a decades-long financial strategy that most people never revisit or fully understand. Now you understand exactly what you are choosing. That is the point.